Do you want to trade magnitude moves or do you want to trade duration moves? That is a question which you need to ask yourself. Magnitude moves are fast, ultra fast moves which happen in a very short period of time. Duration moves are moves which will continue to go up for months, sometimes years. Certain kind of traders are cut out for duration trading, certain kind of traders are cut out for magnitude kind of moves. And especially for those of you who are looking for explosive returns, you will have to trade magnitude moves. Let's look at the difference between these two kinds of moves and try and understand how it is different in terms of approach to trading, how it is different in terms of finding, it is reference in terms of developing a skills for trading this kind of moves. So magnitude moves and duration moves are the two distinct kind of moves, and let's try and look at what is the difference between the two. And magnitude moves are big moves in a short period of time. Stock will go up 60, 70, 80% in 3, 5 or 10 days, or sometimes like in a month the stock will go up 300, 400%. They are magnitude, they are like going up very rapidly. These are like fast moves basically, while a duration move is something which is going to last. The magnitude moves do not last for a long period of time. There are many moves every week which happens which are magnitude moves where a stock goes up 20 to 40%, but then after that it collapses. So magnitude moves have a very distinct characteristic, while a duration moves are moves where the stock keeps on going up and up and up very steadily. It will go up, it will consolidate, then it will go up, then it will consolidate, and in an orderly fashion it will continue to go up, and some of them can continue to go up for 5, 6, 7, 8, 9, 10 years. So those kind of moves are very different from the magnitude moves. Magnitude moves have high speed. Duration moves often are not going to be high speed. They are most likely going to be a low speed moves where the stock keeps on going up. Traders focus on magnitude moves, and traders who are looking for explosive returns, they focus exclusively on magnitude moves, or their setups are geared towards finding magnitude moves. Investors or trend followers are focused on finding duration moves. The kind of scanning which you need to do to find magnitude moves is different from the kind of scanning which you need to do to find duration moves, and the tools which are required is different. As a trader, magnitude moves, I'm trying to capture hundreds of them, hundreds of magnitude moves, and by capturing hundreds of magnitude moves and continuously exposing my money to magnitude moves, you compound your money at a faster rate. And that is why when you see traders make explosive returns or the kind of numbers people don't believe kind of returns people get, is because they are focusing on magnitude moves by design. For duration moves, you need to have ability to hold them for a longer duration, and you're going to find fewer but longer duration moves, while in magnitude you're going to find many but they're not going to last. So that's the difference between magnitude and duration moves. And in order to trade something like magnitude move, first you need the ability to find them very early, because if you're late, a lot of the gains might have already happened. So you need to find them early, and you need to develop the ability to sell into strength basically. And if you are going to become a duration trader, then you need to have the ability to hold for longer term. That means your stop strategy will be different. You'll have stops which will need to give the stock a lot of room to run. And typically this is the difference between swing traders and trend followers or investors. Swing traders focus on magnitude moves. So they are trying to find magnitude moves. They want to enter into magnitude moves early. They want to do many trades with magnitude moves, and because if you are finding magnitude moves which go up 10, 20% in 2 to 3 days, 4 days, 5 days, and you find hundreds of them, by compounding your returns, you make big returns. While trend followers take a very different and distinct approach. They are looking for duration moves. They are looking for something which is going to keep on going up and up and up, As a result of that, the kind of entries they design or the entry techniques is for a stock to first establish a trend. Once a stock has established a trend is when they are entering. So many times the duration move traders, they're entering a setup after a trend has been established. In terms of stops, if you're trading magnitude moves, because magnitude moves move with rapid velocity, your stops also need to move up in that velocity, with that velocity. While in a duration moves, because it is you are buying that duration move with the intention of holding it for a longer duration, stops strategies like moving average based stops or having stops which gives a lot of room for the stock to move are ideal for those kind of situation. The classical mistake a lot of time you'll see traders do is they use moving average stop on a magnitude move. If a magnitude move is of a high magnitude, high speed, the moving average is going to lag substantially, and as a result, you're going to give up a lot of profit. So the exit strategies which you can use in magnitude moves tends to be the one where you sell into strength before the magnitude of the move starts petering out or the velocity starts decreasing. You want to exit those moves. While in the case of duration moves, typical exit strategies are very slowly you exit when the trend changes. As long as the trend continues, you want to be in those. Understanding this difference between magnitude moves and duration moves is extremely important. Many traders have not paid attention to these magnitude moves versus duration moves, and as a result, what they're doing is they are trading magnitude moves, but they are trying to use the thinking and stop strategy and everything which they hear about duration moves to a magnitude moves. As a result, they don't make money. Similarly, if you're going to be trading duration moves and you are putting very close stops or you're going to use the techniques of magnitude moves, then you are not doing justice to a long-term trend and you'll never be able to capture a long-term move. So in your mind, clearly clarify what is the kind of move you want to target. Do you want to become magnitude moves kind of a trader, or do you want to become a duration moves trader? There is nothing wrong with either of those approaches, but your profit potential, what kind of tools you use, what kind of entry techniques, what kind of stop is going to differ. If you're looking for making a killing, go for magnitude moves. If you're looking for steady returns, go for duration moves.